let's discuss the difference between IRAs and Roth IRAs. So first of all, they're both called individual retirement accounts. They're both used if you have what's called earned income. So meaning you actually have to work for that income. You can't use portfolio income, which is interest, dividends, capital gains, or passive income, which is rental real estate, or income where from a limited partnership where you're a limited partner and receiving income without working for it. So you have to have earned income. The current contribution limits are $7,500, and there's an $1,100 catch up if you're age 50 plus. So if you're age 50 or higher, you can contribute that extra number. You can actually contribute. There's no limitation to when you can contribute for either or. There used to be one for a traditional IRA, but now you can contribute for the rest of your life as long as you have earned income. So it's always going to be the higher of your earned the lower of your earned income or the contribution limits. So if you only made, if it's an old person and they just do work part-time and they make, $5,000 a year, they can only do $5,000 a year. But if they make like $20,000 and then they have, they're subject to the regular limitations, which would be the $7,500 plus the $1,100. Now, Roths, one thing to mention is Roths don't have required minimum distributions. Traditionals do, and they commence at age 73. It's actually April 1st of the year after you turn 73, and then after that it becomes December 31st. So if you were wait till that April 1st, you'd have to take a double one, April 1st and December 31st, and then every December 31st. So now that there's no limitation on when you can contribute as long as you have earned income, there could be a situation with a traditional IRA where you are contributing, but then you're also taking RMDs at the same time. RMDs are very formulaic based on your age, and the idea is that you're supposed to get the money out before you die. Basically if someone passes, if it's a spouse, they can actually inherit the IRA as if their own, and if it's for anyone else, it's called an inherited IRA, and basically you're supposed to liquidate it within 10 years. Now, in terms of the specific tax treatment of IRAs and Roth IRAs, the money's going to come in pre-tax. It's going to grow tax deferred, right? The pre-tax thing is nice because it basically takes down what you made in income. So if you made $100,000 in income and, you contributed $5,000 into your IRA or your Roth, for your IRA only, now your taxable income is only $95,000. Now, Roth IRAs, the money comes in after taxes. But the beautiful part about that is the fact that after that, it's one and done. If you wait till you're 59 and a half and 5 years in the plan, 5 years in the IRA, essentially you don't pay taxes on the way out, right? There is a way that you can take out the money through what's called substantially equal periodic payments if it's like the same amount every time, basically every year up until you either hit the later of 5 years in the plan or age 59 and a half. But that's a weird carve out that doesn't really come up too often. I mean, it's kind of a similar carve out for annuities. That's why immediate annuities are not taxed. They're not taxed with a IRS 10% penalty. So not to get too much into the weeds there, going back to IRAs. So with the Roth IRA, the money's going to come in after taxes, then it's not going to be taxed again, which is a big benefit. But the downside is there are income phase outs, right? There's based on what's called your modified adjusted gross income. I wouldn't memorize the rules because they do change. It's around like 150 to 175 if you're single. Basically, if you're like passing 150, you can't contribute as much. You're starting getting phased out. Once you pass 175, you can't even have a Roth IRA. Same thing with like if you're married, it's like 242,000 or something like that. But that number doesn't have to be memorized because that changes. Now for a traditional IRA, there's three things that can happen, right? So let's say if you have a traditional IRA and your income is not substantial, whether or not you have an employer-based plan like a 401k or, whatever, SEP IRA, whatever, you basically can contribute the full limit and everything's going to be tax deductible. So there's actually no income phase outs for traditional IRA, but there are deductibility phase outs. So no income phase outs, but deductibility phase outs. So if you don't have a substantial income, it doesn't matter if you have a 401k and a traditional IRA at the same time, everything's going to be deductible. If you have a substantial income and you don't have an employer-based plan, which is not very common nowadays. I mean, pretty much every company has an employer-based plan, unless maybe you're self-employed, and your company doesn't have that. Then you could, put in the max into traditional IRA. Everything's going to be tax deductible. Option 3, you have a substantial income and you have like a employer-based plan, like a 401k. In that case, you could still contribute to your IRA, but in that case, the income was not going to be deductible. I mean, the contribution is not going to be deductible from your income, so it almost becomes like a non-qualified plan in the sense like an annuity, right? Like a regular annuity where the money comes in sort of after taxes, then it's going to grow tax deferred, and then you can get taxed on the way out. So it's not bottom line, it's not beneficial. So no one really want to do it in that scenario. So that's kind of the basics of IRAs and Roth IRAs. Please listen, like, and subscribe for more information. Thank you. Have a great day.